The first time the Fed started cutting in 2007, gold was 726. So I didn't look back when they started cutting in 2000, but then when the Fed started cutting in 2001 or after the dot-com bubble popped, gold was under 300. Greenspan first started cutting, right? You had gold under 300. When they had to cut rates again, leading up to the financial crisis, gold was 726. When they started the next easing cycle, it was 1412, and now they're starting another easing cycle with gold at 2600, right? This is not a coincidence. Fed keeps easing, causing inflation, printing money, and the price of gold goes up. Now, the question is, how much higher is this easing cycle going to send the price of gold? Because I think this one is going to be the big one.
Peter Schiff, an American economist and financial commentator known for his bearish views on the U.S. economy, has highlighted a striking pattern in the relationship between Federal Reserve policy and gold prices over the past few decades. Peter Schiff highlights gold's consistent rise during past Federal Reserve rate cuts. He notes that gold was under $300 in 2001 after the dot-com bubble, climbed to $726 before the 2007 financial crisis, and reached $1,412 during the subsequent easing cycle. This historical trend is continuing today. Gold prices have soared to a new all-time high of $2,586. Currently, gold is trading at $2,582, up nearly 1%, driven higher by increased expectations of more significant interest rate cuts by the Federal Reserve. Market speculators even suggest that gold could reach the $3,000 mark. Peter also observes that silver is approaching $31, currently above $30, with a more significant percentage gain than gold. Despite this, silver stocks remain well below their 52-week highs, and silver has not yet reached its recent peak from a few weeks ago. The price of silver is down 1.28%, but up 1.02% from a month ago. The 52-week high for silver is $31, and the 52-week low is $27. Silver is anticipated to exceed $30 by early 2025, having briefly surpassed this level between May 17th and May 31st, 2024, marking its first return to this price in 11 years. Peter Schiff also notes that gold is up nearly 25% this year, a significant increase with the year still ongoing. He attributes this rise to the Federal Reserve's ongoing easing, which drives inflation by printing money and, in turn, boosts gold prices. Before watching the video, please subscribe to our channel, hit the bell icon, and share it with anyone who might benefit from it.
Gold is now up 25% on the year. That's a big year, and the year's not even over yet. Now, let's contrast that to what's going on in the stock market, because a lot of people are talking about, stock market's really strong, and it has been strong if you measure it in dollars, U.S. paper currency. So the Dow was up 2.1% on the week. Now, if you just heard that, oh, that's a good week. Dow was up 2.1%. Gold was up 3.2%. So that means in terms of gold, priced in gold, the Dow was down. Even the S&P, which rose 3.1% on the week. In gold terms, it was actually lower. Now, year to date, the Dow is up 9.75%. That pales in comparison to 25%. The Dow is getting crushed this year, priced in gold. Now, the S&P is holding up a little bit better. It's up 18.6% on the year, but it's still down in terms of gold. NASDAQ was up 4.75% on the week. So the NASDAQ beat gold on the week, but it's not beating it on the year. Even with all the Mag 7 stocks and NVIDIA, the NASDAQ is up about 19.8%. And the Russell 2000 also had a good week, up 3.9%. So it edged out gold's 3.2%. But year to date, the Russell 2000 is only up 8.4%. It's getting demolished in terms of gold. The only thing that's beating gold, really, as a group, are the gold mining stocks, but they're not beating it by much. Now, finally, today, GDX and GDXJ finally made new 52-week highs. Even though gold was hitting record highs earlier in the week, these indexes still hadn't caught up. So it took today, right? We had to take out the old high for gold by more than $50 before gold got back to where it was 3 weeks ago, when gold was $50 lower. But the GDX was up 9.3% on the week. And the GDXJ, the juniors, that was up 13.6%. I mean, excuse me, 13.6% on the week and 31.6% on the year. Now, you might think, well, that's a good return. These stocks are up 31% on the year. Not with gold up 25%. With gold up 25%, these stocks should be up at least 50, if not 75%. The reason they're not up more is because investors have been nervous the whole way up. Everybody keeps expecting the price of gold to collapse. On my last podcast, I talked about the fact that 2,500 was probably the new floor, that we could go slightly below it. And I think the lowest we got, ever since we got above 2,500, the lowest we got was about 2,480. And here we are now $100 higher at 2,580. But when gold had a 1% decline from its highs, it went from 2,530 to like 2,480. Gold stocks got clobbered. The GDXJ was down 15%. And so this week, it recouped all of those losses. But the indexes are still extremely cheap. And I still think that people should be buying these stocks as fast as they can come Monday morning, regardless of where they are. Obviously, you need to be a speculator. There's risk in these stocks. But as far as I'm concerned, they may as well be giving them away in Cracker Jack boxes. That's how cheap they are. And gold still going up. Silver almost back to $31, above $30 today, up, percentage-wise. It was a bigger move than gold. Silver stocks, of course, are still well below their 52-week highs, because even though gold made a new all-time high, silver didn't even make a new high from a few weeks ago or a month ago, wherever it hit that level. So silver is still the sleeper, and the silver stocks are very cheap. So over the weekend, you can go to Schiff Gold, as I've been saying. There's no reason to wait for a pullback, because you're not going to get any significant pullbacks. I think the risk is that you're waiting for gold and silver to come down.
PeterSchiff notes that, despite gold mining stocks like GDXJ being the top performers of the day with over a 6% gain, gold itself was not mentioned during his hour-long watch of Fast Money, which is surprising given its strong performance. This notable rally in gold mining stocks, rising 4.3% and on track for its most significant single-day gain since early March, is driven by a surge in gold prices, which have jumped 1.6%. The increase in gold prices is attributed to recent economic data and central bank interest rate decisions. PeterSchiff also observes that rising inflation will push up both consumer prices and long-term interest rates, leading to significant economic impacts that mainstream financial media are currently overlooking. The economy reacts more slowly and with greater volatility to changes in monetary policy during high inflation. In such an environment, interest rates must be kept higher for longer to effectively reduce inflation, contrasting with the more manageable adjustments required in a low inflation state. Let's get back to the video.
If you look at the last couple of rate cutting cycles, the most recent one started in 2019, July 31st, 2019, when the Fed cut rates. And then, of course, they eventually went to zero with COVID. But that first rate cut, gold was at $1,412. That was the price of gold, right? Over $1,000 an ounce lower than it is now. But that was still 26% below the record high. The record high was 1920. So gold was way off its highs before the Fed started cutting. If you go back to the cycle before that, which was the September 18th, 2007 cut that preceded the 2008 financial crisis, but that was the first cut. At that time, gold was at $726 an ounce. It was 15% below its record high from 1980. So the Fed has never started a cutting cycle, at least in modern memory of these cuts, with gold at an all-time record high. And, it's not a coincidence. The first time the Fed started cutting in 2007, gold was $726. So I didn't look back when they started cutting in 2000, but then when the Fed started cutting in 2001 or after the dot-com bubble popped, gold was under 300, right? So when Greenspan first started cutting, right, you had gold under 300. And then when they had to cut rates again, leading up to the financial crisis, gold was 726. When they started the next easing cycle, it was 1412. And now they're starting another easing cycle with gold at 2,600, right? This is not a coincidence that the Fed keeps easing, causing inflation, printing money, and the price of gold goes up. Now, the question is, how much higher is this easing cycle going to send the price of gold? Because I think this one is going to be the big one. I mean, gold is going up. Again, the rise in the price of gold is what shows you that the Fed is making a mistake, that any cut is a mistake, especially a 50 basis point cut, but they should be hiking interest rates. But no one is covering it. On yesterday, gold made a new high on Thursday. I was watching CNBC. They didn't even talk about it. Then I watched this show, Fast Money, for an entire hour. And, they didn't mention it once. The best performing sector, the GDXJ yesterday was up like 6%, over 6%. I mean, isn't that fast enough money for these guys? They didn't even mention it once. Not one guy mentioned gold or a gold stock. They went over sectors. In fact, early in the day, I was watching on CNBC, and the lady, whoever was, talking, said, let's go over the markets. Let's examine what's happening. Let's look at the movers of the day, the sectors that are going, the stocks that are going. And I know the biggest movers are the gold stocks. Didn't mention a single one of them, like as if they're not even stocks. And of course, didn't even mention the price of gold. This should be the biggest topic of conversation. Again, gold up 25% this year. It's beating all the stock market. So why not cover it? But more important than gold going up is why it's going up, what it portends, right? That the Fed is making a mistake. This is a harbinger of much higher inflation. And again, what is going to really complicate and compound the severity of this recession is that rates are going up. Because when inflation rears its head in a bigger way, it's going to not only make consumer prices go up, it's going to make long-term interest rates go up.
Gold is poised to keep rising as expectations for more aggressive rate cuts and a weakening dollar push its performance to new record highs. While gold has outperformed, silver has also gained but remains below its recent peaks. With futures markets predicting further rate cuts, both metals will likely benefit, maintaining strong investor interest in a turbulent economic environment. As gold and silver continue to show dynamic movements, we'd love to hear your thoughts. How do you expect these precious metals to perform in the coming months? Share your predictions and insights in the comments below. If you found this analysis helpful, be sure to like, subscribe, and hit the bell icon to stay updated with all our latest content.